Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, here with you again on Primary Vision Network. Today we're going to discuss three core aspects of what's happening in the world today. So first, we're really going to focus on refining. We really want to dig in and understand why refining is so important as it relates to oil demand and what's going to happen going forward. And then that's going to lead us into these emerging markets. We're seeing a lot of issues in Brazil and Venezuela, and it's going to only expand further and further out, specifically in the emerging market realm of rates and demand. And then obviously we're going to wrap up with our Frac Spread Count, but we all know we're going to be waiting and hopeful has some normalization, let's put it that way, because we need some of this production to come out of the market. So let's really dig in on refining. So we'll try not to get too complicated. And if you want to go even deeper, please ask questions, subscribe, and then ask any question you'd like. And we'll try to go deeper and send you whatever research we can. So the refining world is very interesting. Like right now, we had Mexico come out and declare a force majeure and say to the US, look, we're not taking your gasoline. It caused rates to go negative on the pad 3, which is just the Gulf of Mexico side, and the receiving end, which is in pad 1 or the East Coast on Colonial Pipeline. So we're already seeing these huge issues on the product side of the equation. Now, refiners are the largest buyer of oil. So if you have your refiners at falling rates, which is just how much crude they're taking into the system and making product, you have a long-term problem. And it's a longer-term problem only because you have to work through the product. You need space to take oil and make something with it. So now we have an issue where China, who has ramped up their rates with the state-owned facilities a little bit over 70%, and the teapots or the independent refiners at about 75%, they're already cutting back. So now we're seeing some articles about crude flowing into China and India, but again, that was already purchased. So now the issue is, what are they going to do with it? China has been dumping into the market. Margins are well below negative, which just means that these refiners have no reason to operate, specifically because their local demand is also weak. And when you look at China, who was the first in, first out of this lockdown, you get an idea of how difficult this is going to be on recovery and demand. So you have Spain reporting 47% declines on gasoline demand month over month. You have 37% in diesel demand decline, and that's just one country. When we came up with our 38 million barrels a day of oil demand, we started with the refined product. We figured out how much demand is going to be destroyed, and we just assumed between 20 and 30%. And we're already seeing that 30% may have been a little bit too conservative, which is fine. We wanted to make sure that we had it right. And now as we start to normalize, you look at the US and you say, well, demand has bottomed, which is 100% true. I think it has bottomed. We're starting to see some loosening of the demand cycle as gasoline starts to pick back up. But again, just because we got to the bottom doesn't mean we're going to see this massive increase. Instead, we're just going to kind of bounce around that low point, which is going to hurt oil demand over the longer term. We have more Middle Eastern crude coming in. I mean, now we have dated Brent at, I think yesterday it settled at about 15. Currently we have futures at about 21. So that means you have dated Brent at about 19. And you have these huge discounts in the open market. So, Russia is now out there saying that they're going to sell about, I think it's the lowest ever, it's the lowest in 10 years in terms of export volume. But they have to. They have no choice because the refiners aren't buying. There is no real bid in the market for May and into June, as we know that Saudi Arabia is sitting there struggling to find where are they going to put this oil. So as we go into the next segment, we're really going to focus on, well, what does that mean for rates? Why do rates matter? Why do emerging markets matter? And this is a huge area for diesel demand. And with diesel demand so low, this is also where diesel's storing up. We have Singapore at all-time highs in terms of diesel and storage. When just total refined product and storage, we have Fallujah, which is showing a massive increase in distillate. and in the US. So gasoline was always oversupplied, and we hit tank tops early in gasoline, which meant all of these refiners had to shift into and create as much distillate as possible. Now, how do you make distillate versus gasoline? Well, it's how do you change the process? And the easiest way to do it at the beginning is to change your feedstock. There's about 24 to 26 commonly traded types of crude, and there's over 100 different blends in the world. So you can try to mix and match to create this perfect mix for what you're aiming for, which at this point has been distillate. But as we've seen US exports come down, US demand get hit, and a global issue in terms of total flow, you have an issue in terms of where the future is over the next, call it, let's just say the next few months, when it comes to where is diesel demand going to go over the longer term. And from here, we know that it's going to be slow. It's going to be an arduous process to get these economies back up and running, which is going to hit rates, which is going to hit all types of, refining margins, which is why we're going to have a big problem when it comes to getting these refiners up and running. We have the US, which is continuing to cut their refinery runs, China paring back, and I just think at this point we're going to have a big problem when it comes to getting this oil demand back, given that we have to work through the product. So as we turn forward, we're now going to look at, well, is there more pain to be had on the emerging market side, which is where we're going to really focus on some of these rates and some of this demand cycle. So now that we've talked about refined product storage and why that's going to hinder any real oil demand increases, let's turn to the emerging markets. So emerging markets have been struggling under the weight of debt, which only continues to grow with, I think we're targeted by the end of this quarter to be over 260 trillion. That's a powerful number. There's a cost to that. You have to pay back your interest on that on a quarterly basis. And right now, emerging markets are struggling. They're struggling because they can't export product. They can't actually finance some of this debt, which is why they've had to liquidate their foreign reserves. And how does that work? So if you have a foreign debt in terms of based in euro or dollars, you need to sell your currency to buy that in the open market. So by buying, let's just say in this example, US dollars, you're going to bid those dollars higher, which makes your interest cost more expensive. So what have we done to try to alleviate that? Well, the Fed has opened up 13 swap lines, which is just a fixed rate that is away from the open market. And we've given the IMF the ability to give out about $1 trillion worth of dollars. The problem is it's still not enough because there's so much debt out there. These countries are struggling and their foreign reserves are being liquidated, which means that inflation fears are only increasing, and they're increasing under additional weight. You have food prices going up. You have diesel demand falling, but at the same time, even though you should be able to move product at a cheaper price, you're unable to do it because there is no buyer for your product. So you're not taking in those dollars that you need to operate in a meaningful way. So now what do you have to do? You have to roll that debt. You have to try to raise new debt to cover what you can't already pay, and those markets are closing quickly. So when you look at, let's just say Europe, for an example, the ECB had to have a real conversation of what happens when Italy goes high yield. And when Italy goes non-investment grade, that is going to be a huge shock to the system, which is just a matter of if. It isn't really a matter of if, it's a matter of when. And we've already started to see that in the periphery of Europe and these countries that are going to struggle. Indonesia, Turkey, Thailand, Malaysia are just a few that have seen those problems. Now, what are they really going to move the market? Well, yes, but China is the biggest unknown. Right now they're trying to stimulate their economy, and they really are. I think they're up to 1.5 trillion yuan, trying to get some of this economic stimulus, but again, too little, too late. How much debt can you really issue? I think they're at this point at 35 trillion, and they're clearly trying to go on their way to 40. So but who is the lender? Who is going to give you that money and at what cost? And we've already seen the provinces saying like, look, we have to use our tax revenue to finance this. And our tax revenue is going down because the economy is struggling. So this leverage is really impacting the way the provinces have money to try to stimulate. And then it's just chicken and egg. What comes first? And it's usually, you sell your product, you pay your taxes, and then you get services. And now both of those, selling those products and receiving that tax revenue, are getting hit while you're draining tax revenue in order to finance your previous debt levels. So these emerging markets will continue to struggle as demand remains low, which is going to only remain just as lockdowns are there and consumers are concerned about employment. It's a shock value that we've erased all of these jobs that we've grown since the Great Depression in a matter of several weeks. Now, the problem is those people will not be coming back as quickly as I think the market believes. If you have let go or furloughed 100 people, are you really going to hire back 100 people immediately? Or are you going to do it in waves to make sure that there is demand on the other side for your product that can help finance some of these individuals? So, let's just say, for an example, you furloughed 100 people. Now, things start to normalize, you hire back 10. See how things go, see if there's an increase in demand, then you'll hire back another 10. But you're going to do it in a staged manner. And that's the problem. The staged manner is going to be people who think, oh, I'm furloughed, I'm going to get hired back. Well, it may not be that quick. And that's the biggest problem that we're seeing, not just in the US, but in China, in Europe, and specifically in these emerging markets, where stress in terms of at the home on food, where I think the US, it's for every dollar the US spends about 20 cents on food. And in other areas, out of every dollar, up to 80 cents is spent on food. So food inflation and that concern only grows within these different countries. So this is why we're focusing so much on those rates, because if a country can't roll, then that means that they're going to have to do some form of austerity, or they're going to have to start defaulting on this debt. And defaulting on this debt is a whole other can of worms that we'll go into at a later date. So now that we've talked about refining and we've talked about some of these emerging markets, now we're going to turn to our favorite topic in terms of the primary vision frac spread count and what that's going to mean for U.S. production going forward now that shut-ins have increased and some of these frac spread counts have started to come off. Now that we've touched on some of these key topics, which will roll in at the back of the episode, let's really focus on now the primary vision frac spread count. So the primary vision frac spread count came in at 85 today. So 85 means that we are now down to single digits in all but one basin. And I'm pretty sure both you and I can figure out which basin isn't at single digits at this point. So that is a pace of 62 over last week, because last week we came in at 147. We've been averaging a pace of about 28 spreads per week since about March 13th. So the pace is accelerating, which means that we think we could be by about 50 by the middle of this month. Now, the other interesting tidbit is this is one of the first times where the frac spread count actually almost perfectly matches up with the oil rigs loss, which was about 60, with the total loss in rigs at about 64. So just think about what this means for total supply. This is finally supply starting to come out of the market. And it's not because they wanted to, it's because pipelines, refiners, and storage is forcing it. So now we have this commentary from Mnuchin talking about how we're going to start bailing out energy companies and start taking stakes in these companies. But where do you draw the line? Do you start taking stakes in oil field services? Do you start taking stakes in the guys who deliver diesel to the spreads? Where do you stop? And this is the difficulty in which we're coming into, which is why bailouts in terms of capitalizing profits and socializing losses is a inherent problem. We were built as a country where capitalism rewarded, and then if you failed, you went to Chapter 11 and you restructured. If there are bonds out there that have value based on the acreage available, go to bankruptcy. equitize some of this debt, create value on the back end, create consolidation, create the efficiencies that have built us into one of the greatest countries in the world instead of trying to protect. Because where do you stop the protection? Where do you say this is enough? Like now we're buying high yield debt. Well, there's high yield debt funds. Let them make the money if this is going to make protect some of this debt and some of these companies. There is a slippery slope in which we're going down. And where does it end? Why did we make bankruptcy illegal? And these are the things that we're seeing in terms of protecting inefficiencies. And some have said that, oh, we need a national oil company. Well, why? We've competed on a global stage for the last 100 years effectively, and we've built profits off of it where both shareholders as well as Americans have been able to have a stable flow of gasoline and other products. So we really need to look at, what are we trying to do? What bubbles are we inflating at this point, and how does this end? The biggest issue in the Fed, in the government, is you push a string and it has a knock-on effect, and people are forgetting the knock-on effects. There is a point in time where this all pops, breaks, and all of a sudden, all of this U.S. dollar is going to come rushing back to the U.S. So we've doubled the balance sheet in 3 weeks on the federal side. On the Federal Reserve side. We've increased the balance sheet on the fiscal side. I mean, $7 trillion have entered the market in almost a month. There is a inherent problem in terms of where do we stop? And the problem is where is this going? And we really don't know, but we need to get in front of it. We need to say it's okay to go to bankruptcy. It's okay to restructure. It's okay to equitize. It's okay to go to Chapter 7 if you can't equitize and have that acreage sold to someone who can manage it, who can achieve those efficiency gains. So the law of diminishing returns is real, which means that the cost of doing this is only going to increase to buy a percentage point of GDP, to buy a percentage point of some sort of growth. And these are the issues that we're facing now. These are the issues where emerging markets are suffering under this leverage and debt that's going to be defaulted on. And then what does that look like? When the dollars hit the market, do they come flooding back? And do we have all of a sudden hyperinflation or massive increases in rates? These are things that have to be considered as we go forward. We think we have a handle and we've created some sort of analysis in terms of how we think this goes, where this shakes out. But it all comes back down to have a huge glut of refined products, which is going to keep that oil demand significantly lower than where it should be, even after we have some form of a recovery. It is not a V-shaped recovery. It's not a U-shaped recovery. It's something much uglier, as we've seen with the PMIs. The leading economic indicators on a global level have been showing recession signs since 2019. This is just jet fuel on a raging forest fire, and we really need to get ahead of it and understand how we're going to stimulate while not drowning people in additional debt. So until next time, I'm Mark Rossano, CEO and founder of C6 Capital Holdings, coming to you from Primary Vision Network. If you have any questions, please feel free to drop them in the comments section, and we appreciate every type of subscription and your support. Thanks again.